are earnings reports even that important anymore, given what's happening in Washington, D.C., the vaccine rollouts and everything else?
Well, I guess they remain important in the sense that they're coming in extremely good. Now, a lot of that's already discounted in how much stocks have come up starting last year and obviously continued this year. So I think some of the future 2021 numbers are more important. So I think you're seeing companies trade more off of what the expectations of the rebound in earnings are for 2021. But then you've got this overlay of quite a bit of speculation. You talked about that whole issue in terms of some pressuring on the short sellers. We've got a lot of SPACs coming, all those kind of things that to me, just signal a little bit of a frothy market that's probably a reason to be a little more cautious at the moment.
I keep hearing the arguments and justifications for valuations for stocks at these levels. The biggest case people say is that if interest rates are as low as the way they are, you can afford to have stock valuations like this because the alternative is not very much in terms of a risk-free rate in investments in the Treasury market. Does that hold water?
I think it does. I mean, just listen to Warren Buffett. If you don't believe me, the fact is interest rates matter for stock valuations. That doesn't mean they can't correct, they can't get hit, and then also doesn't mean interest rates are likely to go up over time as the economy continues to go on the mend. So there's going to be pressure from that side. I also think you have to think about future returns. So, future returns are probably lower from stocks over time. But you're right, relative to bonds, they certainly look attractive. And I think that's part of the story, or a lot of the story, as to why money's gravitating to that side.
All right, you can gravitate towards equities in more traditional manners, or you can do so in the way that we've seen for stocks like BlackBerry yesterday, or GameStop, or even Bitcoin to a certain extent here. What exactly is driving some of the bubble type mentality that's developing in certain parts of the market right now? And is it indicative or a warning sign of the broader market overall, or isolated incidents?
I mean, I think what's driving it clearly is low interest rates, and that, the ability, or maybe the feeling that you can take that risk and you might get bailed out in the end. I probably, like I said, I would be more cautious in those areas. I don't have a dog in that fight. I don't think it necessarily has to spill over to the rest of the market. Certainly, you get a risk-off environment. A lot of those names, will get hit pretty darn hard, I suspect, because in a lot of cases, not super high quality businesses were already having trouble. So I would tread lightly there unless you really, know what you're doing in terms of that kind of speculation. We focus here on high quality investments. So it's not the kind of thing, like I said, that I have a dog in the fight there.
Shepard Smith here. Thanks for watching CNBC on YouTube.